The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone. My name is Cheryl Patterson, and I welcome you to the October edition of Digging into the BI. Tonight, we will have 4 presenters giving their rendition of one of each of the stocks mentioned on this page. And let's get started.
Unmuted.
This is our usual disclaimer. This is for educational purposes only, and we are not recommending any of the stocks, mutual funds, or other securities to purchase or sell. And anything referenced in this seminar material for illustrative purposes only and are not to be considered endorsed or recommended by Better Investing or their companies. As always, investors should conduct their own review and company of interest before making an investment decisions. So who are we? We are Better Investing. We're an investment education organization. We are focused on long-term fundamental investing, and we're all volunteers looking at any in the Mid-Atlantic region. So anything to hear that is in blue and underlined is going to take you to where you can get more information on that particular topic. As always, we will venture to get this session as well as any previous sessions onto YouTube. Again, that's the hyperlink up at the top. If you click on that, it will take you to the YouTube for Digging into the BI. Also, the webinars are separated into chapters. So if you wanted to go to a particular company, you could do that by clicking on that particular chapter. Please, in return for this free education program, we ask you to do 3 things. Like the video, share this video, and subscribe to this channel. And that helps with the algorithm for keeping our programs current. The current goal right now is 300 subscribers. So if you are having a problem, either with the audio or other things, that you can look to there's a 4-minute video on getting started. We haven't had audio problems in a while, but if you need to, you can check your computer's audio settings first, or look at help, or look at your audio settings. And please don't forget to download the handouts, because once it goes over to YouTube, you cannot download the handouts from there. So why this webinar? The BI magazine has been a resource that most Better Investing members have looked through, whether it's on the paper copy or in the online copy. It's been something that most of our membership has looked at and read. Also, if you need to, there is in there under that hyperlink a 90-day free trial if you are not currently a BI member, that can get you 90 days worth of looking under the hood of our website. We focus on those who are beginners or uncertain of their judgments within the Stock Selection Guide, or SSG, and or the PERT report. Help those who want to look at best practices of a long-time fundamental investor, and it's a joint program of the 2 Mid-Atlantic chapters, the Maryland chapter and the DC regional chapter. It promotes our model clubs as well as the Club Connect program. If you're in the Mid-Atlantic area, then you're part of this BI community. So in just over an hour, we are going to have each of our presenters present a stock from the BI community. 2 of those presentations are from the BI magazine, which is for members only. One is the monthly stock to study, and the other is the monthly undervalued feature. 2 presentations also from the BI website, BI magazine, or it can be personal experience, something you know of or have had experience with the product. Or there's several other better investing resources such as First Cut, the online screening tools, Ticker Heat Map, Ticker Talk, BI Weekly, and some of the others that are mentioned here. So in order to get the news releases to find out what's coming up in the stocks to study or the undervalued stock, you can go to Home and then About Us and then News Release. And then it can be seen by BI members and non-BI members alike. And you can see in the red circle, that would be your link for going even further in and finding the future magazine for digging into the BI future companies. So don't miss future announcements. As you can see up at the very top, next to a name is in red circle, My Account. If you click on that, and then you go to email and product subscription information that is circled in the green circle, and that's all under Home, and My Account has the red underlining there. And there you will find the different things that you can sign up for, such as the Better Investing Weekly newsletter. And for those of you who have not seen that weekly newsletter, you can, before you hit Save Changes, you can go and check out what is happening coming up. After you make your choices, though, be sure and save the changes. So we've got some Better Investing weekly newsletters that come out usually on the Thursday, late afternoon. And they'll have member exclusive things to look at, say, for instance, the next Ticker Talk or Stock Up. And then they will have First Cut reports or stock ideas. And also coming up, maybe information on the upcoming national education webinar announcements. BINC, or the Better Investing National Conference, is coming up next April. And if you've signed up and you don't get this email, please check your spam filter. Also, you can connect with us on Facebook. Here is the URL right there in blue, again, a hyperlink. And that is for a combination of the DC chapter and the Maryland chapter. It's a joint Facebook page. Notices that can be shared with non-BA members and BI members alike. All right, Maryland chapter events. Who's going to talk about that?
I
Kevin.
will. Yeah, I'm back.
All righty.
You're doing a great job. So anyway, so here's the thing with the Maryland chapter is that they have, they're going to do their first ever game day. It's going to be on Saturday, December 13th from 10 to 2. They're trying to get it over at the South Bowie Library. So those people that know that area, sort of in eastern Prince George's County, the Maryland chapter has been doing quite a few different programs. They've had Jackie Koski come on in, and they've had other presenters. But try this game day. You can click on it. It's free, and you can be able to hang out with other like-minded members. So consider hopping over to Bowie, Maryland on Saturday, December 13th. We can go on to the next slide.
All right, this is the slide of the DC chapter events. We just had our annual planning meeting in the middle of last month. So now we were going back to just having the digging into the BI. You can see today's meeting, as well as the two model clubs that we have, the MCMC, which is the Maryland Model Club, and McNova, which is the Virginia Model Club. And there are the dates, the times, as well as the hyperlink to get you there.
Ken, tell us about your club.
All right, so I am a member of the Happy Destiny Investment Club, started in 2001, and we have 7 partners. We meet on the 3rd Friday of each month from 6:30 to approximately 9 o'clock. And there is the link if you'd like to join us. Our next education presentation will be on how to review your portfolio, and we will have a stock study on D.R. Horton. And if you'd like to contact us, there is the email address.
Thank you. And I'm a member of MCMC, the Montgomery County Model Investment Club. We started in 2017. That picture there is actually about 3 or 4 clubs. What we do is we get together quarterly, a couple clubs, and do a potluck and sort of hang out together. So that was a amalgamation of about 4 different clubs there. But it's a great time to sort of hang out and chat. We meet on the 3rd Wednesday of the month. And we're going to be doing an education, which is 6 signs your SSG might be too conservative. It's a prep session for one I'm doing for Puget Sound. And our stock study is going to be FFB Bancorp. We've been looking at banks for a while, so one of our newer members wants to look at banks. So come join us. It's free online at GoToMeeting. Next slide. Richard, to you.
Yes, and with the Blue Chip Investment Club, I am the treasurer of that club. We are a group of 20 partners. Organization started 35 years ago. We meet on the second Thursday, excuse me. No, this is a Monday. So we're coming up this Thursday. We're going to be meeting live and in person, which I'm a Navy guy, so I like acronyms. So I've converted live and in-person setting to the acronym LIPS. In addition to our portfolio updates, we will be hearing a presentation about the stock Procter & Gamble and another stock called Hextron. Those are our stocks to study coming up. If you're interested in joining us for dinner, live and in person, and some investing insight, I've left my direct message there, and I look forward to hearing from you.
Thank you, Richard. And Andrew, why don't you tell us about your club?
Yeah, sure. So I'm a member of the McNova Club, which is the Model Investment Club of Northern Virginia, McNova. It was started in 2008. We actually have 14 partners at this point. So we got a lot of good cooperation among us, a lot of good teamwork on the club. So if anybody's interested, we meet on the 3rd Tuesday of every month from 7 to 9, and that's online. Or you can call in, hit GoToMeeting, or you can call in. We do an education topic each month. TBD is that we haven't determined what that's going to be this time, but there will be one. The stock to study will be Broadridge Financial Solutions, BR. And feel free to join, and I think you'll enjoy it.
All right. This is a kind of a revamp of a program that they had before with Better Investing, which is called Club Connect. It is for BI members, BI clubs, and people on the free 90-day membership program. So don't have to be a member, but at least be on that free 90-day. It's designed to help connect clubs that are looking for members with potential partners, and also for members that are looking to join a club and not sure what's out there. So it tries to bring those people together. Now that more and more clubs are doing things virtually online, and rather than meeting live and in person, like Richard's club, then you do not have to be a member of a club that is right in your neighborhood. You can be with a different one further out. So it's kind of an interesting program. Please look into it if you are in one of those 2 categories. Back to you, Richard.
actually to me. So again,
I
this
mean,
program,
Kevin, sorry.
it's all right. This program, as we said, is digging into the BI. So we always like to be able to look at something in the magazine that sort of catches our eyes. And you can be able to do this either, I know people wait for the paper version to come, but the e-magazine usually comes on out 2 to 3 weeks earlier. It can also be seen on a computer, laptop, tablet. Over on the left-hand side is an app that's from my phone. You can even watch it on your phone if you want to, not watch it, but read it on your phone. But again, just another way to be able to reach things and get it a little bit sooner. Let's go to the next slide. And this is where, if you need to sign up for digging into the BI for mobile devices, is that green arrow over on the left-hand side. And the other thing is that where that red arrow is, the analyst reports and other resources, that's whenever you see a story about, with the stock to study and the undervalued feature, that they have additional information online. That's where you can find this. So you just come to this part under the Learning Center BI magazine, and you can be able to see those additional reports, the value line, and some other stuff that they usually have of value. And if you click on that View Magazine issues in the center of this page, that's where you can be able to get to see the magazine. Let's go to the next slide. And here's, again, we like to sort of feature a particular article. And this is Betsy Wills. She's a president of the Rocky Mountain chapter. I think she actually just stepped down as a Rocky Mountain chapter. But again, I thought, I always like to look a little bit deeper on the SEC reports, and this management discussion and analysis, or MD&A, is a great way, as she says in this article, for the investor to be able to see how the company looks at itself, in terms of how management sort of sees them. They tend to do stuff, pretty straightforward because they have to be accurate with what they file with the SEC. So if you're unfamiliar with it, go ahead and take a look at this article. She does a really good job of outlining what you have to do. Let's go to our next slide. This one I pull out anytime I see a club or someone from our area that's being featured. I like to give them a shout out. And this is a club that just started 5 years ago, virtual, out of Richmond. And they just seem like it's a really kind of interesting group. So Cheryl, we're going to have to reach out to them and hear what they're doing. They say they like to be able to follow the better investing approach. So we now have to reach out to them since we go all the way down to Richmond too. So it's always nice to see things like that. Let's go
I
to our
thank
next.
God I have visited these folks.
Excellent, even better. So we'll have to bring one of them into the fold. Let's go to our next
Sounds like
slide.
a plan. All righty.
So this slide's a little busy, excuse me for that, but we have the, always on page 51 are the upcoming events. And the one I wanted to feature is, since we have a couple Rocky Mountain folks in the audience tonight, hello Tom, hello Ralph, is that they're having their Investor Education Day on Saturday, October 18th from 9 to noon Mountain Time and the like. So it's free, but they do sort of expect donations, or would appreciate it. You'd get to be able to hear me speak 3 times. I don't know if that's such a good thing, but you will hear me. But I'm looking forward to be a part of it. And there are some new classes in here, as well as some ones that I've taught in the past. And then also, it's not on here, but Puget Sound has their Investor Education Conference, and that's going to be over a couple different days in late October through March 1. And again, that's online, and they are asking for requesting some donations. So go ahead and take a look at some of the schedule there in green, as well as what Rocky Mountain has, and go to their chapter to take a look at it. Let's go to our next slide. So we are about looking at a presentation. So we've just spent about 20 minutes going over some of the basics. We're going to start with 2 stocks in core SSG. Andrew's going to be able to talk to us about the stock to study, Salesforce, which is also in the top 100. And I see I have Booz Allen Hamilton, and I shouldn't have had that. That's actually going to be Ken with Fortinet. It is a ticker heat map, and it is the number 77 on the top 100, but where it says Booz Allen Hamilton, that should actually be Fortinet, and that's going to be Ken Williams giving our presentation. So excuse me for that. Let's go to our next slide, and Andrew, get us started.
Okay, hopefully everybody can hear me. I'm Andrew.
Go ahead.
Okay, great. The McNova Club, as we talked about earlier, DC regional chapter, and this stock is Salesforce Incorporated, listed on the New York Stock Exchange with the ticker CRM. CRM also is customer relation management, so their ticker matches the acronym, or they created the acronym for later. But anyway, it's a stock to study. On the little logo up in the upper right, just to point out, they have themselves as number one. And if you look at, there's some heavy hitters in the competition to the right. And really what they're talking about there is for the CRM software. Obviously, Microsoft and Oracle sell other things and have a broader pipeline of products than Salesforce does. So that's what that's about. Next slide. So Salesforce is actually about 25 years old. It was created by co-founder Mark Benioff and about 3 other people. And basically in his apartment. And here, 25 years later, it is a $37 billion company. And they have about 30% of the market. It is actually pretty unique in terms of their software. Back then, you bought software specific to your needs. They took advantage and leveraged SaaS, which was in its early developments, which is a way of life now, is to use a software as a service. So it's a subscriber type of thing, and he popularized it, and really it's been quite good for them. They have a lot of room to grow. They deal with a lot of companies. I think they have over 150,000 companies subscribers, so it's pretty huge. They have Salesforce is more front end customer centric. The competitors, most of them are more the back end, more database oriented, although that's starting to change a little. And of course, they're trying to integrate Agentforce, which is their AI product. So we'll talk more about that. Next slide. So what do they sell and how do they do it? It's all cloud-based, Sales Cloud, Service Cloud, all of these clouds, depending on the needs of the customer. And it's interesting that they're trying to unify that now, and they're using AI to do that. They're also been in a little bit of a acquisition mode. And the acquisition mode has included some of these companies here, Tableau, MuleSoft, basically to make a better customer experience and enhance what they already offer. And excuse me, and they've been pretty active in that the last few years. Next slide. Salesforce actually has sales and is penetrated 90% of the Fortune 500 companies. This is a list of some of their companies. So they are a big deal. They really are. In addition, they actually, some of their customers are actually their competitors, which is interesting. So next slide. And this is their recent acquisition history. I say recent, I mean about 5 years into it. What's interesting about some of their competitors is most of them are just getting into the front end piece of this. So there has been a little more activity on acquisition for growth from Salesforce perspective, and trying to make sure to get ahead and leverage both some of these smaller companies that they can integrate into their product platforms and integrate into the whole customer experience. Next slide. Okay, on the right-hand side, on the top, is just basically the percent of revenues and where they come from based on the categories they offer. Keep in mind that it's all subscription-based. And if you look at the bold line in the middle of the table below, you'll see 13%, 10, 9, 9, 9. They're forecasting about 9% growth, and they've had about 9% growth. This is actually a company that has already finished their fiscal year of 2025. So they're actually in fiscal year 2026. They don't use the calendar year. Next slide. And when I showed you that 9% and 10%, keep in mind that this company was growing it in the 15 to 20% range, maybe over the past decade. This, I just want to show you some visuals on where they are, where they capture their revenue from, fiscal year 2026, some Q2 revenue there across the Americas, Europe, Asia Pacific. They still have some opportunity for growth in those areas. That top thing is just, that top diagram is just some of all the products they're trying to integrate and use AI to do that. What I wanted to show you on the right is the decline in price. And that decline in price has a lot to do with maybe their forecast has changed a little bit. They've reforecasted and gone a little bit lighter on what the future would look like. A little bit. Also, they've had a lot more competition from some of the AI providers, or at least perceived competition by some of the analysts. And in addition, a lot of the money on the Magnificent Seven and those companies that are pure AI plays, a lot of the money and popularity has sort of gone that way. And Salesforce has kind of fallen out of favor a little bit as a top software provider. But don't, make no mistake, this company makes a lot of money. And we'll see that in a minute. Next slide. With 150,000 customers and 90% of the clients being in the Fortune 500, they do quite well. Q2, if you look on a couple of numbers, the revenue, the small print, 10% year over year. That's very good for a huge company. Profits, very good. GAAP, 22% for the Q2. 2.6 billion buybacks in Q2. Next slide. So I'm not going to read all of these, but I'll give you an idea that the third bullet is probably one of the more interesting ones. They had $30 billion that they planned to use for share buybacks, and they increased that by 20, so they're up to 50 billion. So they plan to buy back $50 billion in repurchase in the next roughly 4 to 5 years. Pretty significant. They just started paying a dividend. It's very small, less than 1%, but they're maturing as a company. So they're not the explosive grower necessarily, but they are a fast grower. Fiscal year 20, they have a lot of cash. Their cash flow is amazing. They have about $15 billion in cash. They have low debt. They bought back $8 billion in shares last year. So this company knows how to make money, and they have a lot of money, and they keep acquiring new customers, and they are leveraging AI to their advantage. Next slide.
5 minutes, Andrew, 5 minutes.
All right, 9% total revenue is all I wanted to show you for fiscal year 2025. That year is over now. Next slide. Now, this is a new guidance. They're saying now 8.5 to 9%. They were a little lower earlier in the year. They said 7 or 8, but now they're restructuring at the 8.5 and a 9. Keep in mind the two little arrows pointing down may have affected their stock price a little bit. They're lowered their gap to their earnings just a little bit, and that could have also played into it. That's for fiscal year 26, which we're in now. Next slide. Up straight and parallel, a black line. There's some of the competitors. I left Microsoft out because it is a competitor, but I just wanted to put some more reasonable companies in there. Microsoft is an amazing grower. Next slide. This is where it gets interesting. I guess it's up in parallel, but it's not straight, really. The black line shows a real zigzag line on earnings, and that's been an issue for them. They really come up high in earnings and then drop very low. And a lot of that has to do with a lot of M&A activity in the last 5 years. They do not borrow a lot of money for acquisitions. Most of the acquisitions are done with cash and stock. So that can affect your earnings per share when they basically for that particular buying, for that particular period. Next slide. So what I want to point out here is return on equity, where it says 6%, right in the middle. That 6% is kind of low. We like 15% usually for better investing. But again, if you're buying companies and using cash and diluting your stock, that number can come down in the calculation. Then the debt to capital down below is at 17, which is quite reasonable. So they don't borrow as much as other companies. Next slide. So the analysts are mostly upbeat. They all believe they have lower numbers going forward, but lower numbers are still good for this company. A lot of the 2-year and companies like LSEG, CFRA, Yahoo only have maybe a couple of year forecast out there. Value Line was a little low on future revenues, but that's an older report. Morningstar was the best one, I thought, has a full 5-year forecast. It was closer to what I wanted to choose for this company with 8.3 sales and 13.3 earnings, and that is what I chose. Next slide.
2 minutes, Andrew, 2 minutes.
All right. Morningstar is very upbeat with them, by the way. 8.3% on sales. Next slide. On earnings, I use 13.3 and get the zigzag in there. Next slide. And for the high and low PE, it was a little difficult to come up with because of the earnings issues. So I had to filter out some of those years. And I ended up with a 5-year average of 48. The PE today is 36.3. High PE was around, average was 48 with a high being 64. With the 36 right now, and Morningstar is forecasting a much lower PE because of increased earnings next year. I chose about 20% higher than that, than 36, which is 44. For the low, I took about 20% lower, which is 29. Next slide. And what you get is a buy. You get an upside downside ratio of 6.3 to 1 with 126% potential appreciation in 5 years with a buy up to 291. I think it's lower than 249 right now today. I think it went down to about 240, maybe 245. That's about 18% annual rate of return with their small dividend mixed in, which is interesting. And the conclusion, again, a large company, 7 to 9% is what the varying publications are saying. They're focusing more on integrating AI and machine learning, mergers and acquisitions, cloud unification. They're, again, a leading vendor. We mentioned the PE of 36.3, and it does appear to be undervalued, so it could be quite a good buy at this point with the current information that's out there in terms of their growth being in the 9-10% range going forward. Dividend is small, and the $50 billion multi-year buyback commitment is also pretty impressive. That is it on Salesforce, CRM, and an interesting moneymaker. Thank you.
Thank you very much, Andrew. Appreciate it. Ken, why don't you tell us all about Fortinet?
All right. So tonight I'm presenting Fortinet, which is a NASDAQ 100 company. Next slide. I actually found out about this when there was a recent drop in the price of the stock. So that's what kind of attracted me to it. And I actually wound up buying some shares at that time. But you can also find it on the Better Investing ticker heat map in the technology section here. And I've put a red square box around it. Next slide. So just as an overview, it is a company that's in the technology sector in the software infrastructure industry. It's a medium-sized company with a Morningstar Health grade of B. The founders of the company are Ken and Michael Shea. So Ken is as a CEO and 8% owner, and Michael is the president and chief technology officer, and has a 9% stake in the company. So together, both brothers own about 17% of the company. and they have been involved with the company for about 25 years now. So it was founded in 2000, and they began as a physical firewall company, releasing its first product, FortiGate, in 2002. In terms of expansion, they established offices in Asia, Europe, and North America in 2004. They IPO'd in 2009 and were listed on the NASDAQ. They specialize in integrated and automated cybersecurity solutions for businesses and governments. And if you had invested $10,000 5 years ago, it would be worth $36,858 today. So on the right side there, you can see pictures of Ken at the top and Michael there at the bottom, who are the founders of the company. Next slide. And then just continue with the overview. So in terms of market cap, they're about a $60 billion company. In terms of their investment grade rating, it's a BBB plus. They have over, they're approaching about 15,000 employees, about $6 billion in revenue, operating margins at 35%. They have $1 billion in free cash flow and about $4.6 billion in investments. Next slide. They are on the Forbes list of most trusted U.S.-based, ranked number 7 for the most trusted U.S.-based cybersecurity company. And they seem to rank quite highly in a number of areas as shown there. Next slide. In terms of their addressable markets and competitors, they have 3 business segments: secure networking, which is about 67% of their sales in 2024, unified SaaS, software as a service, which is 23% of their income. And then finally, we have AI-driven security solutions, which is about 10% of their revenues. And at the bottom there, for each of the segments, I've kind of put some of their chief competitors. So you can see that Palo Alto Networks, Cisco, and Checkpoint Software seem to be the chief competitors in 2 of the segments there, which I've kind of highlighted. Next slide. All right, in terms of competitor advantages, as I mentioned, they're a founder-led business. So the founders have 25 years of experience. They have insider ownership of 17% and have led the company since inception, providing continuity and vision. In terms of a moat, they have strong switching costs due to FortiOS, integrated solutions, and continuous innovation. They have a technological advantage, which is AI-driven, real-time security, and integration with top tech players like Microsoft, Google, and Amazon Web Services. And then finally, they have product capability, offering over 35 plus models of core platform products for small to large enterprises. Next slide. Okay, so Forti Everywhere. So there's 15 years of AI patents and 550 plus AI patents for their various products. So we see they have FortiProtect, which is their and I believe FortiGate is their foundational product, with a number of security services. And we have FortiAssist, which is made up of a number of applications that have grown over the years, or have been developed over the years. And then finally, Forti AI Secure, which has its subsequent products. Next slide. So it's a highly diversified business across customer types, large, small, and mid-scale enterprises over a number of geographies. They are in hundreds of countries, as shown below there. And then they're also involved. Their products are used in a number of industries, as you can see there. The largest being, manufacturing, followed by technology, and then SP, MSSP. Next slide. Next slide. Yeah, okay, there we go. So in terms of competitors, in terms of the way Morningstar looks at it, we have Cisco, Palo Alto Networks, and CrowdStrike. We see that for the most part, most of them have wide moats except for CrowdStrike. But what I did find, rather unique in comparing the four here is that Fortinet is the one that seems to be undervalued at this time. It's probably because of the recent pullback. So, it's an attractive time to get involved with the company if you don't currently earn shares. Next slide. So Morningstar
Five minutes. Sorry, Ken, 5 minutes.
bull and bear case. So in terms of the bull case, they have strong secular wins as endpoint security, cloud security, and convergence of networking security are projected to grow rapidly. Their strength in their high margin firewall segment. Also, the company stands to benefit as clients consolidate vendors and opt for platform-based cybersecurity approach. In terms of the bear case, large public cloud vendors often offer their own cybersecurity solutions, which could hamper Fortinet's growth opportunities. Also, competitors also utilize a platform approach, thereby entrenching them in their clients' ecosystems. And there's always a risk that Fortinet may miss out on the next big technology, therefore allowing its competitors to catch up. Next slide. Next, we have so looking at the value line, they have a timeliness of 2. Over the next 5 years, their price is expected to range between $68 and $153. Annual total return is in the range of 6 to 16%. Annual rates of growth here are at 12.5 for revenues and earnings. Looking at the cash flow, we can see this position below the cash flow line, that dotted line on the graph there, suggesting they're a bit undervalued. At a 36.2 PE. If we look out 5 years on the right-hand side here, we can see that more than 3 to 5 years out, the average annual PE ratio is expected to expand to about 40. So it does offer some PE expansion here. And it appears to be a timely stock if you're a buy and hold investor, according to the comments here. Next slide. In terms of the financial guidance and targets, they're expecting, the company is suggesting 13% revenue growth for 2025 and going out to 3 to 5 years, they expect to be in excess of 12%. Operating margin in 33 for next year and greater than 30% going out the next 5 years. And they expect to meet this rule of 45, within the next 5 years. And then just a free cash flow, they are expecting that to be in the mid to high 30% range. Next slide.
2 minutes, Ken, 2 minutes.
All right. So in terms of looking at the management, we have pre-tax profit on sales, and you see that's well above the 5-year average of 24% here. In 2022, looking at the ROE, there was a dramatic drop there, and that was caused by a decline in the average shareholder equity, which is the denominator in ROE. So that became a negative number due to the company's aggressive share repurchase program. Also in 23, there's a dramatic rise in ROE. The company experienced that's attributed to strong product revenue growth, accelerated service growth, and improved. It should be improved, not approved, logistics. So that's kind of the key things that were going on in those 2 years. And then with respect to debt to capital, they are well below their 5-year average of 84.6%. So next slide. In terms of my sales and earnings judgments, I kind of went with 12 and 12 for the sales and earnings. And since they didn't guide too much, they expected to be in excess of that, but they didn't really give a more defined range above, the 12%. So I just went with that as a bottom. Next slide. I'm going to use 43.3 as my high PE, which is the low end of the 5-year high PE range, high average PE range, and then I'm going to use 27.9 as my low PE, and then $70 for the low stock price. Next slide. Next slide. All right, so that based on those judgments, it's in a buy range with a 6.5 to 1 upside down ratio. Next slide. With a total return or a price appreciation, 5-year return of 17.3%. Next slide. So in conclusion, it's a medium-sized company that's well managed. It's undervalued as it's trading below its 5-year average PE. It is a buy up to $100.40 with a 6.5 to 1 upside downside ratio and 17% return. I believe it's a worthy candidate for your consideration. Next slide. And then with respect to the core thesis, it is a well-positioned, a company that's well-positioned to capitalize on a booming cybersecurity market with low debt, high margins, strong founder-led leadership driving innovation, while risks like reliance on Taiwan for hardcore product and concentrated distributor sales exist, and competition from cloud-based solutions appears to be growing. Fortinet's adaptability and proven track record in the network security make it a compelling investment with significant growth in a digital-first world. Next slide. This is my justification for where I put it on the business cycle. I wasn't really expecting this slide to be in there, but it is. So when we discuss the business cycle, this is why I put it where I put it. Next slide.
All right. Thank you very much, Ken. Next, we're going to look at 2 stocks using SSG Plus, and the first one up is going to be Richard, and he's going to be able to look at the undervalued feature for this month, and that's Accenture. So go ahead, Richard, and tell us all about Accenture.
I sure will. I'll do my best to do that, and I wanted to welcome everyone that's here tonight, and I hope what you hear tonight is something that will be something that you'll want to research on. My research on Accenture is a global provider of essential business services. I just want to make a note that the last time I made a presentation, Kevin, you might recall that was Eaton, and Eaton is based in Dublin, Ireland, which is where Accenture is also based. So I think that was kind of unusual. There are 33 Irish domiciled companies traded on the New York Stock Exchange, and so now I've covered 6% of them. Next slide.
Way to go.
Accenture was selected as an undervalued stock by the Editorial Advisory and Securities Review Committee, and it is featured in this October 2025 edition of the Better Investment magazine. And if you look at the cover of that magazine, you'll notice that it's the second issue of volume 75. The contributing editor, Kevin J. Laman, is compiled the report. Accenture was the featured stock to study in the same year that it moved its headquarters to Dublin, Ireland. And for more member-driven insights, click the link and visit Better Investing's First Cut stock reports. Next slide. The first commercial computer, which General Electric used in the early 1950s for manufacturing control at its appliance park in Louisville, Kentucky, came to life after Anderson's feasibility study in 1953. By the end of the 20th century, though, arbitration disputes led to full separation from Arthur Anderson. And just in time, Arthur Anderson got caught up into two accounting scandals. You might remember the malfeasance involving Waste Management and then Enron in the early 2000s. Accenture's IPO was July of 2001, and it marked a pivotal moment, raising $1.7 billion and launching its journey as a global leader in consulting and technology services. They pivoted to AI, cloud, and digital services in the 2010s and helped transform its base of clients and customers. Next slide, please. Accenture ran its offices and operations, and it does this in 52 countries and more than 200 cities. Accenture is the fourth largest overall employer in the world, behind retailer Walmart, but it is the world's largest professional services provider with over 750,000 employees serving clients across the world's continents. From innovation hubs in Dublin and Tokyo to delivery centers in India and Latin America, Accenture's global footprint enables it to scale solutions, tap diverse talent, and deliver locally relevant impact. It's not just global, it's borderless. Next slide. Earlier, now, let me get back to my point. Accenture serves over 9,000 clients globally, including industry leaders like Amazon, BP, and Medtronic. In fact, 95% of Fortune's top 100 companies have been working with Accenture for a long time. Andrew earlier mentioned Salesforce. Accenture has a partnership with Salesforce, so they're happy that CRM is making money. One federal contract is still moving forward. They had some headwinds and had some problems with the federal contracts being taken away from them. But you'll notice that the Air Force is the one that is down around 7 o'clock on this graph. Accenture has a strategic partnership with the Air Force to modernize its technology infrastructure. With NVIDIA, Accenture launched a dedicated business group to scale agentic AI using the full NVIDIA stack to reinvent enterprise operations. And with Salesforce, Accenture empowers clients to deliver frictionless AI-driven customer experiences through platforms like Data Cloud and Agentforce. These alliances position Accenture at the forefront of the digital transformation. Note that Accenture is also partnered up there just under the letter S. You'll see Accenture and the NFL. Yes, Accenture is partnered up with the NFL for international games. There's one coming up this Thursday morning on the NFL Network, in which Green Bay will be playing as one of the teams, and Green Bay marks the 32nd and final team to play in London since 2007. Next slide, please. Accenture's global reach is reflected in geographic revenue mix. North America leads with 45%, followed by EMEA, which stands for Europe, Middle East, and Africa at 34%, and the global markets contributing 17%. This balanced footprint supports a diverse client base across the regions. By industry, products is the largest segment. By retail and consumer demand, communications, media, and technology components include high-tech and software platforms. Financial services include banking and insurance, while health and public service did work for government agencies. Resources encompasses energy, chemicals, and utilities. Each piece of the pie represents a strategic pillar in Accenture's multi-industry expertise. Next slide.
5 minutes, Richard, 5 minutes.
According to Morningstar, Accenture has a wide moat. It competes with all of these firms that you see here. What sets Accenture apart is its ability to integrate and deliver end-to-end transformation for clients worldwide. Next slide. From fiscal 21 to 25, Accenture demonstrated robust financial momentum. Revenue climbed from 50.5 billion to nearly 70 billion, a 38% increase driven by digital, cloud, and AI services. Diluted EPS rose, and it reflects steady earnings growth. Pre-tax profit reached 10.3 billion in fiscal 25, and fiscal 25 just ended August 31st, up 32% from fiscal 21. Long-term debt stayed low throughout, under 3 billion, reinforcing Accenture's commitment to financial discipline and strategic investment. Next slide. Accenture's stock peaked at 398 in February of 2025, but soon faced many headwinds. The Department of Government Efficiency, the DOGE, led by Elon Musk, began slashing federal projects, consulting projects impacting Accenture's U.S. public sector. Then in March, the company's earnings revealed a drop in new bookings, signaling some softer demand ahead. And despite strong margins and AI momentum, investors grew cautious. Add in global pressures and Trump-era procurement slowdowns. The result was a sharp market reaction, sending shares down 20% in just 6 weeks. Next slide. Accenture first paid its dividends in 2005, and since then has periodically increased the payoff. According to Accenture's newsroom, the dividend will exceed $6 per share in fiscal 26. Sorry, did I miss something?
No, you're fine.
Okay. Next slide. Accenture's acquisition strategy is a key driver to long-term growth. In fiscal 24, $6.6 billion invested, 39 acquisitions, and in fiscal 25, thus far, 10 acquisitions, $1.5 billion invested. These acquisitions strengthen Accenture's service offerings. Next slide. Sorry for a lot of this happening going on this slide. Value line long-term earnings estimate at 12.5% annually, to me, seems a bit steep. Morningstar awards 4 stars. Being undervalued is a rare occurrence. You can see most of that is in the orange. That means it's overvalued. There's only a few instances where it shows up as blue. Might be some interest, and it won't stay that way for long. I found the metrics table on Schwab's website. Single-digit growth is the vibe, and you can check out the company's earnings report by clicking the link. Next slide.
2 minutes. 2 minutes, Richard.
Up straight in parallel, I took in consideration the previous data shown, and I combined it with the 190 member sentiments, which are studies that are done on better investing to generate projections. And a picture tells us 1,000 words. I'll let you ponder the remainder. Next slide. In addition to the first cut stock studies and several analyst inputs, I leaned heavily on the mean sentiment from BI's member-driven stock studies. So that's where I got a lot of my input of information. Altogether, Accenture was the benefactor of more of these studies. So I feel confident in the statistics that were provided. Next slide. So in conclusion, they are a mega large size mature company, fairly well managed. They offer a solid dividend. The stock price has pulled back from being overvalued. It's a buy up to $293. And I would suggest that you check out the links that are in this report.
Thank you very much, Richard. Another very good presentation. So appreciate it. I'm going to finish up tonight talking about Catalyst. And Catalyst is a club holding, and it's also in my personal portfolio, and it was also in the first cut earlier this year. So let's go and talk about Catalyst, and if we go to the next slide. So Ken actually is the one who presented Catalyst back in December of 2023. We bought it about a year ago, and we've lost a total of $64 as of this weekend and stuff. But, you know, Ken pointed out in the original presentation that it's a growing revenue with a diversified portfolio. What they do is they're doing a sort of a lot of late stage orphan drug development. And so you may say, what the heck that is? I'll talk to you about that in just a minute. But overall, I think we can see there's some things here that will really carry over into whether this thesis still holds. Let's go to the next slide. So again, Catalyst is in the S&P 600. It came in 2023. You can see its sales size is relatively small. They're out of Coral Gables, so the Miami area. They have been public since 2006, and they really focus on orphan drugs, predominantly in the central nervous system. And again, there's some interesting prospects that come through with this. Let's go to our next slide. So what is an orphan drug? It's a drug that's designed to serve an underrepresented market. Basically, someone who has it impacts 200,000 patients or people. You do that as a comparison. You look at blockbusters. Those are ones that a definition of a blockbuster is anyone who has annual sales greater than $1 billion. So you can see where it's at the other end of the spectrum. And Congress created this Orphan Drug Act to be able to give financial incentives to drug manufacturers so that they could start making some of these life-threatening, help people with life-threatening illnesses that otherwise they wouldn't be in there because they couldn't make the big bucks that they could on a blockbuster. So that's where it's been. Let's go to our next slide. So, the concern when legislators were looking at this, 40 years ago, is it, they wanted to be able to get these specialty drugs out there, but you'll also see a lot of times stories of, these people are charging extraordinarily high prices for drugs. And, that's sort of the trade-off that goes with this is that, there really weren't many orphan drugs that were developed prior to the Orphan Drug Act. And in the 20 years after it, you can see how much it's gone up, that they were developing over 1,100 different orphan drugs when prior to that they didn't even do 100. So orphan drugs, they'll get the patent protection, they get an expedited review, and they get this market exclusivity for 7 years. So they can be able to make hay in the early years of this, and that's sort of like what the business model is protect their patents, be able to get through stuff really quickly, and then be able to make hay real quickly in that 7-year time period. Let's go to the next slide. So if you want to learn more about it, the first one up there, that YouTube channel, I mean, the channel is named Iran is Our Temple. And I was just like, what? But I tell you, that little short 7-minute outline, I thought did an excellent job of outlining everything that's going on in Catalyst. So if you want to take a look at it, there's a hyperlink. Seeking Alpha also was good at looking at the business model that they have and how they can grow. And again, I think when you're new into this area, and I'm not an expert on orphan drugs, is to be able to look at some of the studies that go on with it. And I found, again, that A Motley Fool had a good story. It's 6 years old, but it's still, I think, pretty relevant to where's going on. But I think that's one of the things that when you're looking at these companies, if you don't understand the industry, try to figure out how the entire industry operates. And these stories, I think, will do a good job of it for you. Next slide. So the other thing is that when you're getting one of these younger, smaller companies, is that it's really hard to be able to find good information on them. This um, Catalyst is covered in the standard edition of Value Line, but it's not covered by an analyst at Morningstar, nor is it covered with an analyst at CFRA. It does have the expanded edition of CFRA where it's a quantitative, but I sort of like to see someone who's done some digging in. In Hoover's, which you can get through the Baltimore City Library, so anyone who's in the resident of Maryland can be able to get it, and you may want to look around. But this is a really interesting and great way to get a nice background on it. I'm actually going to be talking with Mark Robertson and Ken Kavula about how to use Hoover's sometime here later on this month when we do one of the bull sessions in the evening. So I'll go through that a little bit more, but let's go to the next slide. And one of the things I really like about Hoover's is they really give you a nice background in a very short setup, but they also do a good job of finding their competitors. And they look at, they can usually find out how many employees they have because it's in their financial reports and what they're making. So I found this really pretty good. And like I said, they work in the developmental stage, really sort of the late development. In other words, Catalyst is not the one who's doing the R&D to bring a drug to market. They find one, maybe it's overseas, and they end up saying, look, we'll take the American market and we'll try to be able to squeeze something out in that 7-year time window to sort of expand things and sort of make our money kind of quickly. So that's sort of where they fit in there. So they really have to be diligent in terms of their legal defenses. I mean, all drug companies have to really do a lot of patent protection, but they also want to be able to protect their exclusivity for the 7 years that they have. And people are always trying to challenge that so they can get in, because the threat is, of course, once after that 7 years, the generics come on in. So that's sort of where their real battle is. Next slide. So here's a visual analysis, and there's new CEO, Richard Daly. He came in early in 2024, so it's relatively new. All the rest of this, and I took out some of the earlier numbers because they look kind of crappy, but also we see some really good consistent growth since 2019. But the founder, person who got things started, he retired. He's now a chairman of board of this. But you can sort of see that does have up, straight, and parallel. And that line between the magenta and the gold, that's going to be your taxes. And then between the gold and the blue, that is your shares outstanding. And what you see pretty consistent. There's not a lot of dilution of the shares outstanding, and the taxes seem to be matching pretty well. And also the pre-tax profit is continually moving closer to the green line. So we can see a lot of good things in terms of our visual analysis on Catalyst. Next slide. If we look at section, thank you. So the other thing is that if you look at this, the pre-tax profit is excellent, which is quite common for drug companies. But I think also these orphan drugs, they really do make a large amount of money in a short period of time. So they're constantly looking for new ideas to be able to do that. But you can see, again, Pre-tax profit return on equity is great, almost no debt. And I also like to look at what the Morningstar financial health grade is. And in this particular case, it's an A, which puts it in the top 10%. So you know you're getting a strong balance sheet along with some other metrics there with almost no debt. So they're in a pretty good position. They just have to be able to go on out and find some late stage orphan drugs that they can be able to sort of acquire. That's going to be a challenge. Next slide. If you look at some of the revenue guidance, here's one of the things. FY Compa is going off patent completely, so they'll still sell it, but they're going to drop their prices, obviously, to stay competitive with generics. But FY Compa, the generics started coming on out in May of this year, which is one of the things that sort of drove down their price with that. FY Compa was 25% of all their sales. But again, they have enough money and they're well positioned and they have a history of acquiring these sort of late stage orphan drugs that they, again, don't do the development, that they're ready to sort of bring them to market as quickly as possible. And that's sort of where their specialty lies. Next slide. And again, you can sort of see here the newer stocks or the newer product lines at the bottom. FY Compa again is going off patent, but the Finder Labs and the A Gamma, hopefully I'm saying those right, huge growth. The one in the top that's dealing with LEMS, Lambert-Eaton syndrome. And so that's sort of their biggest one going through right now. But I thought it was kind of interesting, the commentary that was in Value Line at the bottom there is that this price, the price dip, it looks like a buying opportunity if you really think that this is a method that's going to continue forward. And I think so. I think there's a lot in here. They're really sort of specialized in this type of stuff. And they don't have to worry about the big pharmaceuticals companies coming after it because they're always trying to develop the next blockbuster. And these are sort of people that instead of trying to hit the big home run, they're just trying to get on base and maybe get from first base to second base. And that's sort of the way to look at a company like this, is that it's not going to be competing with your Pfizers of the world. Next slide.
2 minutes, Kevin, 2 minutes.
Thank you. So here's the sales growth. Again, I took out all those early years. And yeah, I could have kept the sales growth up around 40%, but I didn't think that was realistic. My 16% really matches what Manifest has for sales growth. It's higher than the forecasted growth in Value Line, but some of that's also because of the way they do the methodology in Value Line, but also that they are much more cautious in where they are going forward. I think that they can really hold it at 16% when I do a preferred procedure, and also realizing that they're talking about doing some dilution of shares to be able to give them off as stock bonuses. Even when I factor in that, I still get a 12.4% future earnings per share, which I think is still quite reasonable. Next slide. Again, if you look at this section 3, look at that current price, the current PE at 12.6. You look at it compared to the 5-year average at 15.5. It really seems to trade in this pretty consistent window from 21 going forward. And if that's the case, thing is really beaten down and should have a great opportunity to bounce back up. So we get both PE expansion and earnings growth. No dividend payout. That's a wonderful opportunity to make some money. Next slide. Here we are looking at the section 4, and you can see I'm not really doing any wild or crazy PE numbers here. I don't think I'm really outside the norm. I get an upside downside ratio of 6.8 to 1. My low price there at 14.8 is significantly below, and I purposely picked something that would be on the low side just to be able to protect myself on the downside risk, even though it's dropped a lot in this last year. So I think that I'm being cautious, but at the same time, looking for an opportunity to make money. Let's go to the next slide. So here we are with section 5. Again, they don't pay a dividend, but I'm getting an upside downside ratio 6.8 to 1. Total return is at 24. It's not as high as what you see on Manifest, but theirs was a little bit in the nosebleed section. I think that return somewhere between 16 to 24 is probably a pretty good number. I get it to buy it up to 26.6, and you can see it selling just below 21 as of Friday. So let's go to our next slide. So it's a small sized company. It has really good growing pre-tax profit margins, well managed with a low long-term debt, undervalued. And that's sort of the biggest thing is it's both well managed, undervalued, and has growth opportunities. And so those types of things sort of lead me to believe that I think it's a buy. It's a buy up to 26.6. I think it's worthy of being added or looked at further, since we're not necessarily suggesting that you do buys or sells, but take a look at it a little bit more going forward as something that you may want to investigate further. Next slide. All right, so we went through all four of these relatively quickly, but we'll do a recap. We like to talk about where the life cycle is, and why don't we just go to the next slide? And here we are with T. Rowe Price. And why don't we start with Andrew? Why don't you give us why you have that location for CRM?
Sure. Well, I like this curve, but I always look for numbers. I don't see numbers on this. So, to me, explosive growth is, it depends on the size of the company, but for a big company, a relatively large company, 15 to 20% is pretty explosive, 20% or so. And I don't see CRM in that side of that line. So I see it more in the other, and they did offer a dividend, very small. And that kind of indicates that they're maturing a little bit, but they're still a fast grower. So I put them sort of on the close to that line on the mature growth, because I think they were around 8 or 9% growth, which is still pretty phenomenal for that large company.
Okay, and Richard, why don't you do Accenture?
Kevin and the audience, I believe that Accenture it's a mature company. So I put it right in that mature area. I think it's a real good investment because it's undervalued and it is a well-managed company, as you had mentioned, Kevin, those two things happening. They have already exploded in terms of being where they are now. But as shown in the Morningstar slide, they've been overvalued for a long period of time, and now are where they are. They're in a good, and in fact, what I think is the best investment opportunity.
Okay, and I'll tell you with Catalyst, I have it towards the tail end of explosive. I think there's still a lot of growth in there. It's still relatively young. This is sort of a real niche market in terms of where they are, but I think that they can have that kind of really good growth opportunity, and that's where they sort of fit in there. And Ken, I know I didn't move your slide all the way back, but Cheryl, if we can move back to slide 65, Ken can then talk about Fortinet. Hit 6.5. If you just hit 6.5 and then hit return, we'll come back to it. Or we can go this way. Passed it up. There it is.
For me, right there.
Yep.
Okay, so this is a tool that I came across from Brian Feraldi, and it was created essentially by Brian Feraldi to kind of assess where a company is in the business life cycle. So he looks at revenue, gross profit, operating margin, net profit, and share count. So in evaluating Fortinet, those are how I scored them. So based on that scoring, it winds up being there in section 3, self-funding. But those are the various metrics that are reviewed to kind of determine where a company might be in the life cycle. and that's how I scored it for Fortinet.
Okay, thank you very much. Cheryl, so yeah, if you could just hit 100 and then hit return, we'll go right back to where we were. There we go. And we can go to our next slide. And now we can release, thank you for doing that, Cheryl. Let's go ahead and release a poll. We have a really good turnout tonight, so thank you very much for everyone being here. And you get a chance, we're not necessarily saying which one do you want to buy, but which one interests you enough that you want to be able to do some additional research before you make your own decision on what you want to go with. And
I want to vote. No, I can't.
all right, we got about 50% of you voting right now. Got a dead heat. We got someone moving up on the outside there. Can we get up over 60? We're moving over 60. Let's see how active our audience is tonight. Looks like we're taking a break here.
We can do it. We can do it.
Can we? We're at 62. Let's see if we can get up over 65. Anyone? Come on, just one or two more votes. All right, Cheryl, no one's moving. Go ahead and close it out and let them see it. And there you have it. We consider that well, that is a dead heat. There must have been one last vote in there because they were 36-32, and now it's 35 and 35. So a dead heat between Fortinet and Catalyst. Very good. Kent, do we have any questions in the audience? It looks like it's been kind of a quiet night tonight.
It has been a quiet night. Most of the questions were regarding issues around access and information. However, let me pull up this one question and pull out the questions here. Okay, up, and folks have left, so they'll have to get their information later. So, nope, no more questions. We're all good there.
You can also raise your hand, and we'll unmute you if you want to. Instead of writing your question, you can just open up your microphone. If there's anyone in the audience that have looked at or own one of these 4 stocks and want to give us your insight, we're willing to be able to take that. Write something, raise your hand. A lot of shy people tonight.
We actually part of our portfolio is Salesforce. I just want to make a mention of that.
Okay.
We follow Salesforce, and I like that pharmaceutical thing that you did. I would have voted for pharmaceutical and put you over the hump, but I didn't get that chance.
Well, that's okay, because otherwise Ken would be very upset if he lost to me. He's very, very jealous if he loses to me.
All right.
Because there's gloating.
No questions. No questions. I think we've got. Folks are shy tonight.
Good. Again, a good audience tonight. Over 70 people here. Very, very good. Let's move on since we don't have any questions. And again, if anyone wants to, go ahead and raise your hand and we can go back and chat about some of these. But here's how you can get additional questions or comments. You can be able to reach us here at digging into BI at email at Gmail. There's the contact for both the Maryland and DC chapter. There's a picture of many of us that have done presentations, and that was at Bink last year in 2024 when we were in Chicago. And that's one of the things I'm really proud of, is that I've had over 40 different people make presentations, and we generally get about 25 to 28 different people per year making a presentation. It's a great way to be able to promote your club and to be able to also practice and develop your skills. So if you're in this area, and even if you're not, I even sent a couple of you, I saw you in the audience and I sent you an email asking, we do need some people to help us fill out the rest of the year and early next year. So please let us know. We'll help you do that, and you can be able to promote your club as well. Let's go to the next slide.
Well, also, before we flip over, both Kevin and I are more than willing to help you with presentations if that's not your strong suit. So please don't feel like that's holding you back.
Mm-hmm. So, and if you need to be able, again, all of you are here, but if someone is looking at this online, this is how you can get on the mailing list to be a part of it. You'll see the URL is up at the top in sort of that light, sort of goldish, orangish thing, faint. That's where you can be able to find us. We don't inundate you with lots of emails. It's usually just news and notifications about what's going on, investment stuff. So please consider that. And let's go to another slide. Kent, all you.
Alrighty. So as Kevin and Cheryl have both mentioned, this effort works only with the energy that folks put into it. So our volunteers are the key to making this particular effort on digging into the BI magazine work. And so we like to have more volunteers to help out with that. And and to entice you a little bit, you do get to get some new skills that you get that you get as far as presentations and also research skills. And then there are great ideas, like Ken pointed out, about how to figure out where on the business cycle your company could fit. Additionally, you get the good feelings of helping to educate others and providing newcomers to better investing insights into how we do our analysis work. Further, you can get discounted rates to the Better Investing National Conference as well as national training programs, and then get complimentary subscriptions to the Better Investing tools as well as the Mutual Fund Education Center. So all of those things are really good reasons for you to join, but helping out and keeping better investing healthy and moving forward into the 2030s is one reason why we need our volunteers. Next slide, please.
Okay. I was actually looking at some stuff. Here's what we have coming up in November. We're going to have Robert Haft as the undervalued feature and FactSet research. I see I have another mistake there. I say CRM. It is not CRM. It is FDS for FactSet research. Boy, I need to do some better editing on this, but that's going to be Monday, November 3rd. I'm still trying to fill out the list with some presenters. I sent a couple emails to folks in the audience. Hopefully you're able to read those things. And if you're able to help us out in either November or December, we could certainly use a few more people to help carry the load. But anyway, that's what we have coming on up. Let's go one more slide. We do have stuff up on Manifest Dashboard, but I have been really lax in getting stuff up this year. So we're almost done with the year, so I better make sure that I keep working on that a lot faster. But anyway, there is a list of all the stuff that's gone on there before, and let's just keep going. There's the hyperlinks for all of the stuff. We break it out into those that were won and those that were selected by the presenters to sort of take a look at it. Again, you don't have to be a member or get a subscription to Manifest. These are all free, and otherwise you can be able to get a subscription to Manifest at a very reasonable rate to take a look at that. Next slide. We'll have stuff up eventually on YouTube and the like, but that's our hyperlink to go with it. One last look. Do we have any questions from anyone in there?
Everybody, please download the handouts now, if you haven't done so.
Exactly.
And no additional questions out there, so we're good for the night.
Oh. And again, a little self-serving but promotion. October 18th, Saturday, from I think it's 9 to noon Mountain Time. We're going to have their investor fair. I'll be talking about how to look at visualizing cyclicals, 6 signs your SSG is too good to be true, and how to update your SSG to take a look at it, sort of do's and don'ts. So come and join us. I'm really looking forward to being a part of that with the Rocky Mountain chapter. We got everything set with them. And again, you don't have to fly out to Denver to do it. You can take it from wherever you are. And no other questions. I think we will say good night. I think that's really it. But thank you again for being here. A very nice turnout. We're very pleased with that. Good night, all.
Good night.
Good night. Right on time, too.
A military man would notice that right away.
Yeah,
It was
Richard,
very good.
you and I need to talk sometime. We have a lot in common.
We do. You helped me put together my first presentation on Albemarle, so that got me on the right track. This was number 3 for me. I will say this: generative AI work. If you tell it what you want to do, that what you're working on, and what the body of your work wants to be, it'll give you a presentation and how to set it up, and will help you design slides, which appeared in tonight's program.
Very good. All right. I think we're just down to a few folks. So go ahead, and I think we can shut things down. And again, thanks all for being here. Have a great night.
You too, Kevin.